Good morning. This video goes out to Jenna, who asked for a refresher on free cash flow from an asset and financing perspective. We're going to begin this morning with the free cash flow from an asset perspective. Up here at the very top, you can see your formula, which is cash flow from operations minus change in net operating working capital minus change in gross fixed assets. So I'm going to get rid of these numbers so that we can develop them ourselves. The first thing we need to determine is our cash flow from operations, which we know is equal to EBITDA minus taxes. And as you'll recall, EBITDA is simply your earnings before interest, taxes, depreciation, and amortization. So let's go ahead and calculate that. We're going to pick up our net income of $150. We're going to add back our interest of $50, our taxes of $500. We're going to add back our depreciation of $500 and our amortization of $0. And that is going to equal EBITDA of $1,200. We know our taxes were $500, and so our cash flow from operations is simply $1,200 minus $500, or $700. What that's telling you is that your operations generated or created $700 of cash, which is a good, positive thing. However, we need to know what else happened with the balance sheet in order to determine whether or not free cash flow from an asset perspective was positive or negative. So let's take a look at net operating working capital. And we know that that is equal to current assets minus nibbles. And remembering that nibbles are our non-interest bearing liabilities, we'll page down a little bit here and take a look at them. Our non-interest bearing liabilities are accounts payable in this case. If we had accrued expenses, they would also be non-interest bearing liabilities. We do not use current liabilities because that includes notes payable, which are an interest bearing debt. The bank is not going to loan you money without asking for interest. So we need to pick up just the accounts payable in this case. Let's do that. The current assets minus our nibbles for the first year, for the most recent year, is $5,100 minus our accounts payable of $500, or $4,600. For the prior year, our current assets were $2,500 and our nibbles were $1,500. So for the prior year, our net operating working capital was $1,000. The change is simply the most current year minus the prior year, or $3,600. The next and third final piece of our formula is gross fixed assets and the change in gross fixed assets. We want to use gross fixed assets, which is the plants and equipment line, not the net fixed assets line, because otherwise we would be double counting the impact of depreciation. You'll recall that we already took into account depreciation back up in the EBITDA, so we don't want to double count that. In this case, our most recent year gross fixed assets were $2,500. Our prior year gross fixed assets were also $2,500. So our change, which is most recent year minus our prior year, is 0. So if we look at our formula for free cash flow from an asset perspective, we're going to see that we need to pick up our cash flow from operations, which was $700, minus our change in net operating working capital, which was $3,600. Minus our change in gross fixed assets. So you can see that we have a negative $2,900 for our free cash flow from an asset perspective. What does this mean? What it means is that although our operations generated $700 of cash, our activities on the balance sheet used up $3,600. So we actually ended up in a deficit position, that is using more cash than we generated out of operations in our free cash flow from an asset perspective. That will be offset by an equal amount of activity on the financing side that occurred in order to finance or pay for the activity here. Remember, the free cash flow from an asset perspective must always equal the free cash flow from a financing perspective, except they will have opposite signs.